They just changed the rules. Not quietly, not slowly, but deliberately, right when everyday investors started winning. $52,000, that is the number they want you to accept as normal. That is the price tag they just placed on your ability to participate in the silver market. And if you do not understand what this number really means, you are about to watch the biggest wealth transfer of the decade happen without you. This is not market regulation. This is not risk management. This is a trap. A carefully designed financial mechanism built to extract you from a winning position and hand your profits to the same banks that have manipulated this market for 40 years. Right now, silver is trading at approximately $115 per ounce on your screen. That is what COMEX, the paper market, tells you silver is worth. But here is what they are desperately trying to hide from you. In London, dealers are quoting physical silver at $120 per ounce with a 2-week wait. In Singapore, $135 with limited availability. In Australia, premiums have hit 18% over spot. In Germany, you cannot find 1,000-ounce bars at any price. There is a $13 to $20 gap between what paper silver trades for and what physical silver actually costs. That is not a premium. That is a confession. That is the market screaming that paper prices are fiction, and the $52,000 margin requirement. That is their attempt to silence that scream before you hear it. Stay with me until the end of this video. I'm going to show you the 3 historical precedents that prove this exact trap has been set before. I am going to reveal the one document from 1980 that reads like a blueprint for what is happening right now. And I am going to tell you the single move that makes their $52,000 barrier completely irrelevant. This could be the difference between building generational wealth and watching it transfer to the very institutions that are losing billions right now. Welcome to the hidden economy. If you're ready to see what Wall Street does not want everyday investors to understand, like this video, subscribe to this channel and hit that notification bell. Because what I am about to show you will not stay hidden much longer. Let me start with the trap itself. Because most people see the $52,000 margin requirement and think it is just another market adjustment. It is not. COMEX just announced that the maintenance margin for silver futures is now $907 per contract. That is a 35% margin requirement. To put that in perspective, that is insane. A standard silver futures contract represents 5,000 ounces. At $115 per ounce, that contract controls $575,000 worth of silver. Under normal market conditions, margin requirements sit between 5% and 10% of the contract value. They just doubled that. They went to 35%. But here's what makes this a trap instead of a policy. They did not do it all at once. They did it incrementally, strategically. 3 weeks ago, the margin was $22,500. Then it went to $28,000. Then $35,000. Then $42,500. Now $52,000. Each increase was announced with 24 to 48 hours notice. Each increase forced traders to make an immediate decision. Post more cash or close your position. This is not risk management. Risk management would have set appropriate margins from the beginning. This is a systematic liquidation engine designed to shake out everyone who does not have unlimited capital reserves. And here's the mathematical proof that this is targeting everyday investors specifically. At $22,500, a retail trader with $50,000 could hold 2 silver contracts and still have cash reserves. At $52,000, that same trader can barely hold 1 contract with 0 buffer. One more margin increase and they are forced out completely. Meanwhile, institutional traders with $10 million in capital can still hold 100+ contracts comfortably. The percentage impact on them is negligible. This is wealth extraction disguised as volatility control. Now let me show you why they are doing this right now. Because the timing is not coincidental. The timing is desperate. I have the COMEX delivery data from the last 6 months. And what it reveals is a full-scale bank run happening in slow motion. March 2025, 16 to 149 contracts stood for delivery. That was the largest delivery month in COMEX history. 80.7 million ounces of physical silver demanded. May 2025, 15,122 contracts. Another record attempt. July 2025, 13,140 contracts. September 2025, 13,640 contracts. December 2025, 12,981 contracts. And here's where it gets absolutely wild. January 2026, right now, as I am recording this. January is not a primary delivery month. January is supposed to be quiet, a minor month where nobody demands physical delivery. January 2026 is currently the 6th largest delivery month in COMEX history, in a month that should not even register. 9,529 contracts have already stood for delivery with trading days still remaining. That is 47.6 million ounces. In a minor month? Do you understand what that means? It means traders do not trust the paper market anymore. It means they want metal now, not promises for later. It means the divorce between paper and physical is accelerating. And when I look at who is issuing these delivery notices, the picture becomes even clearer. JP Morgan Securities, 312 contracts issued in the last 3 trading days. That is 1.56 million ounces of physical silver flowing out of their vault in 72 hours. Why would JP Morgan, the bank that paid $920 million for manipulating precious metals markets, suddenly start delivering massive quantities of physical silver? Because they are covering their shorts, because they are trapped on the wrong side of the trade, because they know what is coming in March 2026. March is a primary delivery month. If January, a minor month, is already 6th largest in history, what do you think March is going to look like? The vaults are being drained, the banks know it, and the $52,000 margin is their attempt to stop the bleeding before the hemorrhage becomes fatal. Now, before I show you the 1980 document that proves this is a repeat playbook, I need to tell you something that happened to me 4 days ago. Because this gets intense, and you need to know this is real. I was at a local coin shop, small place, family owned for 30 years. The owner, Mike, has seen every market cycle. He has seen silver at $5. He has seen it at $50. He has seen it crash and recover a dozen times. I walked in to buy some rounds, and there were 6 people in line ahead of me on a Tuesday afternoon at 2 p.m. I've never seen more than 2 people in that shop at once. Mike looked exhausted, and when I got to the counter, he said something I will never forget. I've been in this business for 33 years. I have never seen demand like this from regular people, doctors, teachers, Uber drivers. People who have never bought an ounce of silver in their lives are coming in and asking how much they can buy, and I am running out of inventory faster than I can restock. When local coin shops are seeing run-on-the-bank level demand from people who have never participated before, something fundamental has shifted. The awareness is spreading, the trust in paper is breaking, and that terrifies the people who control the paper system. All right, back to the trap. Let me show you the historical precedent that proves this is not the first time they have used this exact mechanism. The Hunt brothers, Nelson Bunker Hunt, and William Herbert Hunt, 2 billionaire brothers from Texas who saw the same thing we are seeing now. Inflation, dollar debasement, silver undervalued. They started accumulating physical silver in 1973. By 1980, they controlled an estimated 100 million ounces. The price of silver went from $6 in 1979 to $50 in January 1980. The Hunt brothers were winning massively. And then COMEX changed the rules. On January 21st, 1980, COMEX announced Silver Rule 7. This rule prohibited new long positions in silver futures. You could only sell, not buy. The rule was specifically designed to crash the price and force the Hunts to liquidate. Then they raised margin requirements. Repeatedly, dramatically, the Hunts could not meet the margin calls. On March 27th, 1980, known as Silver Thursday, the price collapsed from $20 to $10.80 in a single day. The Hunt brothers lost billions. They eventually declared bankruptcy. COMEX destroyed them by changing the rules mid-game. Now look at what is happening today. Margin requirements raised 6 times in 3 weeks. Paper price diverging from physical. Delivery demand at historic levels. Banks trapped short. Read the 1980 congressional testimony from the Hunt brothers case. Read the COMEX board meeting minutes that were later released. The language is identical to what we are seeing in 2026. Protecting market integrity. Ensuring orderly markets. Managing excessive speculation. Those are the exact same phrases COMEX used to justify destroying the Hunt brothers, and they are using them again right now. But here's what is different this time. In 1980, the Hunt brothers were alone. They were concentrated. They were visible. COMEX could target them specifically. In 2026, the demand is global. It is decentralized. It is millions of individual investors across hundreds of countries. You cannot write a rule that targets everyone without exposing the game completely. That is why they are using margin increases instead. It is a softer weapon. It looks like policy instead of targeted destruction. But the goal is the same. Force liquidation, crash the price, escape their short positions. Now let me show you the 3 types of people watching this video right now, because your response to this information will determine which side of the wealth transfer you end up on. The first type is the experienced stacker. You have been buying silver for 5, 10, maybe 20 years. You watched it go to $50 in 2011 and then collapse. You watched it trade sideways for a decade while Bitcoin and tech stocks exploded. You have been patient, maybe frustrated, but you held on. And now finally, you are profitable again. But you are scared. You have seen them smash the price before. You have seen the manipulation, and part of you is waiting for them to do it again. To you, I say this: do not let them shake you out at the finish line. The manipulation is real, but so is the supply deficit. And physical always wins eventually. The difference between 2011 and 2026 is that the physical market is breaking free. The vaults are empty, the game is ending. The second type is the curious newcomer. You have heard about silver. You have seen the headlines. Maybe you own some stocks or crypto, but you have never bought physical metal. You're trying to figure out if this is real or just another bubble. To you, I say this. Verify everything I'm telling you. Go to the COMEX website. Look at the margin requirements yourself. Check the delivery data. Call your local coin shop and ask about availability and premiums. Look at global prices on Bullion Vault or Kitco. Do your own research, then decide. The third type is the skeptic. You think this sounds like conspiracy theory nonsense? You believe markets are generally fair. You trust that regulations are designed to protect investors, not institutions. To you, I say this. I respect your skepticism. I was skeptical too. But ask yourself one question. If the silver market is fair, why is there a $20 gap between paper and physical? If COMEX prices are accurate, why are people in Singapore paying 18% over spot? If this is just normal volatility management, why did they wait until delivery demand hit record levels to raise margins? Just look at the data, not my interpretation, just the numbers. Then explain to me how this makes sense. Now, here is what happens next. Because there are only 3 possible outcomes to this situation, and you need to understand each one. Outcome 1, the trap works. Retail investors cannot meet the margin requirements. They liquidate. The selling pressure crashes the paper price. Banks cover their shorts at lower prices. They escape. 6 months later, after retail is wiped out, silver rises again. The institutions win, regular people lose. Outcome 2, the trap fails. Despite margin increases, delivery demand continues. The vaults keep draining. In March or April, COMEX cannot fulfill delivery obligations. They invoke force majeure. They settle contracts in cash instead of metal. The paper market loses all credibility. Physical prices decouple completely. A 2-tier market emerges. Paper trades at one price, physical at another. The people holding real metal win. The people holding paper, promises lose. Outcome 3, regulatory intervention. The price spike becomes politically visible. Congress gets involved. Emergency measures are announced. Trading halts, new rules, possible windfall profit taxes, chaos and uncertainty. Unknown outcome, but almost certainly bad for anyone playing the paper game. I believe we are heading toward outcome 2, and here is why. The supply deficit is real. The Silver Institute projects 2025 to 2026 will see the deepest deficit on record, nearly 280 million ounces more consumed than mined. The industrial demand is accelerating. Every electric vehicle needs 1 to 2 ounces of silver. Every solar panel needs 20 grams. Every AI data center requires thousands of ounces. This is not speculative demand. This is industrial consumption that destroys the silver permanently. The geopolitical fragmentation is accelerating. China's export restrictions are real. Russia is hoarding. India's import taxes are creating parallel markets. The globally integrated silver market is fracturing into regional blocks with different prices. And most importantly, trust in paper markets is collapsing. When Tokyo traders pay $140 for silver, while COMEX says $115, that is not irrational. That is a rational response to a market they no longer trust. Now let me tell you what I am personally doing, because you deserve transparency. I hold physical silver. I have been accumulating for 7 years. My average cost is somewhere around $23 per ounce. I'm significantly profitable right now. I'm not selling a single ounce. I'm holding through whatever volatility comes. On significant dips, if we see paper prices crash to $90 or $95, I will buy more, small amounts, money I can afford to lose. I am not trading futures. I'm not playing options. I'm not buying silver ETFs. I hold physical metal in my possession. No counterparty risk. No margin requirements. No liquidation notices. That is my strategy. Yours should fit your situation, your risk tolerance, and your financial goals. But here is the critical distinction that makes the $52,000 trap irrelevant for physical holders. When you own physical silver, you own the metal. There are no margin requirements. There are no margin calls. COMEX can raise margins to $100,000 per contract, and it does not affect you at all. You bought metal, you own metal. End of story. The $52,000 trap only works on people playing the paper game, the people who thought they could use leverage to amplify returns, the people who trusted that the paper price represented reality. Physical holders are outside the trap entirely. This is why premiums are exploding worldwide. This is why Singapore dealers are charging 18%, why Australian mints have multi-week delays, why German investors cannot find large bars. Smart money is exiting the paper system and going physical. They have seen the trap. They are stepping around it. Now, let me give you the other side, because I would be dishonest if I did not. Could silver crash from here? Absolutely. In 1980, it went from $50 to $10 in months. In 2011, it went from $50 to $14 over 4 years. History shows that silver is volatile, brutal even. Could the manipulation continue working? Yes. They have tools we do not see. They have political connections. They have regulatory capture. Never underestimate the power of institutions fighting for survival. Could I be completely wrong about all of this? Yes, I have been wrong before. I will be wrong again. Markets are unpredictable. No one knows the future. This is why you never invest money you cannot afford to lose. This is why you diversify. This is why you make decisions based on your own research, not YouTube videos. But here is what I know with certainty. The $52,000 margin requirement is not normal. The sixth largest delivery month happening in January is not normal. The $20 physical premiums in foreign markets are not normal. The 70% inventory drawdown since 2020 is not normal. The 8% lease rates are not normal. Something is breaking in the silver market. The old system is failing. The paper prices are losing credibility. And when systems break, wealth transfers from those who do not see it coming to those who do. The question is, which side of that transfer you will be on. Now let me give you my timeline, not hopes, not wishes. This is what the data suggests is coming. February through March 2026, extreme volatility, more margin hikes possible, scary headlines, media calling it a bubble. This is the shakeout phase. Weak hands exit, strong hands accumulate. April through June, physical shortages become undeniable. Coin shops run dry, mints announce delays, premiums persist at 15% to 25% over spot. The divergence between paper and physical becomes mainstream news. July through September, delivery stress at COMEX becomes visible, possible cash settlement events, lawsuits from traders who demanded metal and received cash, regulatory hearings, the paper market's credibility collapses. October through December, two-tier pricing is established, paper-silver trades at one price, physical at another. My target for physical is $180 to $220 per ounce by year end. Paper might be at $130. The great divorce is complete. Could I be wrong? Always. But the setup has never been this clear. Let me give you one final thought. Throughout history, every paper money system has failed. Every attempt to suppress real asset prices has eventually collapsed. Every manipulation scheme has an expiration date. The $52,000 margin is not a sign of strength. It is a sign of panic. It is a desperate institution making a desperate move. And desperate moves rarely work. The banks are trapped. The vaults are draining. The physical market is breaking free. And the $52,000 barrier they just erected, it only keeps out the people playing their game. But you do not have to play their game. You can hold physical. You can step outside the paper system entirely. You can own real metal that no margin increase can touch. That is not financial advice. That is just observation. What you do with it is entirely up to you. I want you to do something for me. Screenshot this video, save the date. Come back in 6 months, come back in 1 year. Let us see together how this plays out. Because 5 years from now, January 2026 will be remembered. And you will either be grateful you saw it coming, or you will wish you had paid attention. The trap has been set. $52,000. That is the price of playing their game. But here's the secret they do not want you to know. You do not have to play. Drop your thoughts in the comments. Tell me if you are seeing shortages in your area. Tell me what premiums your local dealers are charging. Let us build a global picture of what is really happening. Share this video with one person who needs to see it. One person who has no idea this is happening right now. And remember these numbers. $128 in London. $138 in Singapore. 18% premiums in Australia. $150 on your screen. That gap is the truth they cannot hide anymore. Subscribe to this channel for daily updates on what is really happening in the silver market. Join the community of people who refuse to be exit liquidity. This is the hidden economy, where the real story is never on the surface. I will see you in the next one. Stay awake. Stay informed. And whatever you do, do not let a $52,000 trap decide your financial future.